I think it was a mixture of things. Certainly there was to a certain extent, there was a sell fact. Everybody knew it was going to be quite a strong result given what we've seen in Q4, and that came through. And the stock has risen strongly into this result. So I think some people are taking profits. Just on the outlook, I think management were reasonably cautious around you wouldn't necessarily extrapolate out what was a very strong 2020. Having said that, there are some positive signs for 2021 in terms of record or near record backlogs for M&A. And they expect that to feed through into a still strong ECM activity as well. I think they were being quite cautious about some of the perhaps frothiness in the markets around SPACs, and they said that probably wouldn't continue. But I think they still see that there'll be some fairly good M&A activity as we go forward.
I want to pick up on the cost angle as well, because there was a clear distinction between what we heard from Bank of America yesterday and Goldman Sachs. And Bank of America explicitly said that their expenses were higher due to expenditure related to the pandemic and making arrangements in the new work from home sort of environment, in addition to investing in health and security. Whereas Goldman had actually much lower costs, and that is one of the reasons why they had such a strong EPS beat. Why the divergence? Why was Goldman able to control their costs and Bank of America were saddled with so much extra costs versus expectations?
Yeah, so I think the main difference is really the different types of businesses which you have there. Bank of America, much more of a retail bank with 4,000 branches nationally. And a lot of the COVID-related expenses they're talking about are really about refurbishing some of those branches, making sure they're COVID secure as and when they reopen. So that costs a lot of money, and they're talking perhaps an extra $1 billion worth of costs during the year. Goldman Sachs, by contrast, is much more of an investment bank, doesn't have a retail branch franchise at all, and really doesn't have those additional costs. And the reduction in costs which they saw in Q4 was almost entirely on the compensation side, where they decided they'd actually already accrued enough for performance-related pay earlier on in the year, and therefore they didn't need quite so much in Q4. So I think there's really just a different types of businesses which they have.
John, when it comes to the outlook, one of the areas of caution that management teams have expressed is that the strength we've seen in investment banking and in particular in markets may not be sustainable, the magnitude of the strength that we've seen. Looking at Goldman Sachs, to what extent is this strength down to gains in market share? And if that is a primary driver of the strength, can we expect Goldman Sachs to see more resilience, more sustainability than some of its peers?
I think there's a couple of things within that, and certainly the market share gains are real. The biggest factor driving the exceptional strength though in markets in 2020 really was the extraordinary volatility we had in Q2 and Q3. That resulted in pretty wide bid-offer spreads, and that results in bigger revenues for the firms. Even in Q4, once the bid-offer spreads had come in, you saw a lot of macro activity. Obviously, you had the election, you've had the virus resurgence, had Brexit. So that's driven a lot of activity in those sectors as well. I think management are fairly cautious that that kind of extraordinary activity will likely come back in 2021. Having said that, they are pretty confident they have picked up market share. Goldman Sachs is quite well renowned for basically staying there for their clients and for the markets and making markets even in the most troubled times, given the strength of its balance sheet. And that is reflected in higher market share. Goldman Sachs has also been out very proactively, trying to change a strategy over the last 2 or 3 years, really focusing a lot more on trying to service their clients more aggressively. And that's also helped them win market share. So whilst they're saying 2021 will come back from a more normal, from an abnormally strong 2020, we still think it'll be above 2019 given their market share gains.